Oh, we're live, right? Okay, so we're live once again from New York City, NBC or CBS or something, our own network. How about the Rotary network? We have a famous guest here. Sonny has joined us, and many other guests. So what we're going to do is continue last week, that panel, the financial panel that we started, and in the same order. I'll go last, so I can eat my breakfast. We're going to eat, in between talking, we're going to eat, so if you don't mind. And like last week, fire your questions as you may. I think that would be okay, wouldn't it, guys? Instead of waiting to the end, because people think of things, go ahead and shoot them out. We'll take about 3 or 4 minutes each, and then we'll encourage questions.
I thought just questions now, because we've already done our 3 minutes.
Well, you could repeat part of it or come up with some new news. As the housing market collapsed between last week and now. So do whatever you like. Tell stories, anything during your 3 minutes. Just have that. This is all ad lib anyway. There's no script. So
I think we might run out of time again.
Yeah, we could.
So just ask the questions, because most of the people were...
Maybe just do a quick little recap.
Okay.
Just like a little short one.
So Maury will start with a recap. I like that idea.
Okay.
A recap of the housing situation here.
Thank you. So last week, I set out to say what the end of November looked like. And this morning, there were no figures for the December yet, because both the California and our local board were saying that the MLS were having some technical difficulties. So it's still the November figure that San Mateo County, the median home price was over $1 million. In San Francisco was it like 900 something, 900,000, and Santa Clara was also similar.
So question, Maury, that $1 million price, that's countywide? That's hard to believe.
Yes, countywide.
Isn't it hard to believe when you have only like Daly City and Pacifica and everything like that?
Yeah, but we have Atherton too,
Yeah.
and we have Hillsborough. So
And
it
East
just
Palo Alto.
says, well, yeah, but that's not being, so we have the very high end and we have the very low end of the spectrum. That's why the median price is the one that is usually being announced versus the average price.
Gotcha.
Because when you say the average price, then you won't have a true picture of how the market is.
Okay, so that answers my question. So your median price is the halfway between the lowest sold house and the highest sold, right?
The median, the average.
Well, the average is taken arithmetically, taking all the sale prices, dividing them by the number.
The number, yes.
That would be the average.
Right.
Well, what you're talking about, the million.
The median.
Median is between the lowest and highest, is that correct?
Right,
Yeah,
correct,
okay.
yes.
I guess that makes sense, because you got a $10 million
We all knew that, Ken.
Huh?
We all knew that.
Oh, okay. Okay, good.
We're gonna refresh it.
I'm the last one.
Okay, so,
Remember, Ken's in real estate.
so that's it for my recap. If you want some hot housing trends of what people will be looking at, in the future in terms of homes, I have that too, and you can just email me and I could forward that information to you, what people are looking for in the house, in homes. Okay?
So how do you see going forward? Do you see any slowdown with the worldwide economy and the fact that the yen is dropping off and where euro is dropping, all that stuff? Any impact?
Well, I had said that last week that there could be some slowing down because those were the buyers,
Chinese.
the Chinese, and then the Russians are slowing down, of course, because of their economy. And you have investors who are buying a lot in bulk, or casual investors, like first-time investors looking for rental properties. The amount of money that they get in flipping would not be as good as a couple of years ago, for example, because the prices are starting to go up.
They're starting to level off, maybe.
No, starting to go up.
Go up, and wouldn't the flippers like that?
No, the flippers won't like that because then they have to put out and compete with the high-priced buyers as well. The first-time home buyers that are, they're buying. And a little slowed down too, perhaps because of the millennials. With the tightening of the bank regulations, they're looking at credit scores and credit history, and millennials, those that are aged 18 to 35, don't have a whole lot of credit history.
And moving on to Eddie. This is Eddie's second meeting here, and Eddie is a lender. Very unusual that a lot of people maybe haven't had exposure to. So take it away, Eddie.
Thanks. My name's Ed Elliott, and I work in a small boutique private finance company. We're local here from Hillsborough and Burlingame. So we've been on Beauvais Road for about 38 years now. Same office. Right across from the old Burrell Bank, Boston Trust there. We have private investors, and we arrange, we sell debt instruments, secured debt instruments. Our regulatory bodies that control us are Department of Real Estate and ERISA. We do alternative loans that banks don't do. Generally, we work on investment properties, not owner-occupied. We have real estate licenses. We're realtors, and we have the federal endorsements on the NMLS. So we have the government endorsements. We basically work with high net worth individuals to people that have, are starting out. Minimum investments are $25,000. Have some people with substantially more invested with us, and we work with a lot of pension trustees, and the relationships can go 10, 20 years, because we work with those pension funds over a long period of time. I'd say probably 60% of our money is pension money, self-directed, set money. A lot of it is self-directed from individuals, mostly local and San Francisco. But we do loans to $4 million. We arrange them, we underwrite them. We're not a mortgage pool or a trustee pool. We assign individual lenders to individual notes, and it tends to work out a lot better for the individual over a long period of time, or the pension fund.
Most of your loans are short-term or long-term?
Our loans range in term from 12 months to 3 years.
That's the average.
Yeah, and I'd say the average is 2 years. The yield's right now about 9%. They're all first trustee loans.
Why so short?
Because there's a lot of retired people, and they don't want to be too far away from their money for their estate planning.
But so, you're loaning for up to 2 years, is that what you're saying? 2 to 3 years. And then they have to resell they have to refinance their homes then?
Or they can sell, or we can extend the loan or rewrite the loan, depending on their financial needs, the borrower's needs. Each loan stands on its own. We underwrite each one individually. So we go back out and see what's going on with the property and the borrower, and revisit the situation and decide if we want to keep the loan or have them, pay us off.
But you do extend quite a few, don't you?
Yeah, we extend quite a few. Yeah, we go back, and a lot of borrowers, if they're current and their taxes are paid on time, we'll offer them an extension. Yeah. But that's our choice, not their choice.
Ed, so you talked about investors, so people come to you and they put money into this fund.
It's not a fund.
Well, vehicle,
Yeah.
and then you place the loans with people, and so the money that you put in are you casting off monthly payments?
Yes, there's monthly payments.
Back to the investors?
Correct.
And what's kind of the return?
9% right now.
He's in.
Okay.
Monthly payments, yeah.
You have his
Yeah, from listening to Ed's conversation, what I get is this business is about integrity, and it's also about personal care for the person. It's not about money, it's about the person and the relationship. It's great.
Yeah, we have some competitors. A lot of the bigger funds in the last 5 or 6 years, a lot of them, particularly through the recession, a lot of them got in trouble. For example, there was some funds in the East Bay, I won't mention any names, but there's the one that group had $750 million, about 750 million, and they would get a yield. They take a spread off of their investor pool of maybe 2 or 3% to operate their firm, and reduce the yield to the investor that way. But they also were not, they compromised their underwriting by doing that, because they thought the pool was like a blind pool, and they didn't have to deal with the individual investors. Where we have an open door policy. Anyone can walk into our office and sit down and talk to us. We'll go through a loan file and it's all there. We get audited every year because we have quite a bit of money, so the state comes in and audits us.
But back on that,
Ken, are we gonna
go to movement, okay. Yep, good, thanks, Frank. Moving on.
Okay, well, good morning. I'm Gloria Guzman. I'm with San Francisco Federal Credit Union, for those of you that haven't met me. I've been in the credit industry for over 30 years. I've been with this credit union a little over a year. We are new to the San Mateo area. We now serve anyone who lives, works, or goes to school in San Mateo County.
Since there's so many credit unions, what's the difference between each one?
Yeah.
It's just, we're different. We may have a lot of the same products and services, but they're just priced differently, just like the banks. But the difference between us and the banks, as far as credit unions, is that we do collaborate. We work together in so many different ways because we are not as large as the banks. Example that I think I gave last week was you can use San Mateo Credit Union's ATM if you're a member of our credit union, and there's usually no fees, or there is no fee. So we use each other's machines. We can actually go into their facilities from time to time, depending on if they're part of the service center, and make deposits and withdrawals into someone else's credit union. So Nevada Credit Union, I can walk into there if I'm in Vegas and make a deposit or a withdrawal, and there's no fees. So we collaborate in that sense, in the sense that we are cooperatives. Our fees are usually, well, no, they're not usually. They are lower than the banking fees. When I mean by fees, is more like the non-sufficient funds or overdraft fees, those kinds of things, ATM fees. Let's say you're down, I mentioned last week, Cucamonga, there's no machine, not even a credit union machine, but there's only, let's say, a Bank of America one. Then we will reimburse you that fee, because obviously there wasn't a credit union that you could use your ATM at no charge. So things like that. As far as services, again, it's just a matter of seeing which credit union works for you. Some credit unions, they're very specific in the sense that if you might not even be able to join their credit union. So, for example, maybe Travis Credit Union, they're more towards, military, so obviously I can't walk in there and join. But a lot of the credit unions have become community charter credit unions, and that's because of some of the mergers that they may have taken over. So I was a merger back in 1994 with a large credit union, but it was the same field of membership, so it kind of worked out. And that's usually what the NCUA looks for, is match credit union so that it doesn't kind of overlap too much. So that's really just the difference. I mean, they may have, some credit unions will have maybe lower rates when it comes to auto loans. So just every credit union works in the capacity of whatever their needs are to keep, you know, a good balance of their assets and their liabilities. I think I did answer your question, yes.
How secure are they versus a bank?
Well, I give you an example. This credit union's been around for 60 years. The credit union I was with before was 70, almost 75 years. So and it's not that credit unions, some credit unions do merge, but they don't go away in the sense that you don't lose anything. You know, we just merge over or whatever the case is, so it just really depends.
Credit unions have the equivalent of FDIC, which is CUNA, and they insure deposits just like FDIC.
Is it also $100,000 security?
250,000. Yeah, and if there's a spouse, then it would always be 250, 250, as long as they hold their own membership accounts. So it's NCUA, National Credit Union Administration.
What rate does the investors make?
Well, it depends. I mean, from time to time, we'll have a good CD promotion, those kinds of things. So it's just, right now we don't have one. We have them like April and October. I don't know, go anywhere from, don't laugh, okay, you guys? Because I do all the time, no. You know, 1.25, but I'll tell you this, we do beat a lot of our competitors in the area. So we do really well when we have our promotions. I mean, I see people, we're here in Burlingame on El Camino, and it's a good location, and we have like 20% member penetration. But anyway, so we do really well, I mean, in that sense. So again, it just depends on what we need to balance. I mentioned last week that we are going to introduce a no down payment mortgage loan. Don't have all the specifics yet, but that is coming and it is going to happen. So we're hoping to launch that in April. One of the things I mentioned was about paying yourself back also last week. How important it is to save even with the low rates. It's always good to have that cushion. And so one of my main goals this year, and always has really been, is educating the youth and getting them started on the right foot. Because we know once they go off to college, they start getting all these credit card offers, and they just start signing away, and before you know it, they're in debt before they even get out of school. I'm actually doing we're doing a big presentation at the Burlingame Library on February 2nd for the youth, and that's called Bite of Reality, and basically that's what it is. You know, you want to start a family, you want to buy a car, you want to buy this, get ready, because these are the things that you need to be prepared for, those kinds of things.
Student loan?
Sorry?
Student loan?
It's for, well, not student loan, it's just life. In other words, how important it is to save and those kinds of things and have that cushion for the emergency. We talked about if you're single, you should have at least 3 months worth of your monthly expenses saved up. If you're a married couple or significant other, you want to make sure you have up to 6 months of savings put aside. And again, we're talking about pay yourself first. Always put aside. The rule is usually like 10%, but I know that's difficult in terms of living here in the Bay Area. So even with savings, it looks like it's starting to happen again. People are still saving, but people are also now borrowing more. We're seeing a lot of more members coming in to borrow more because they're feeling that comfort level. You know, the economy's coming back up in some sense, so they're going back out and buying cars, getting credit cards, and those kinds of things. So I do a lot of that type of education as far as, not to get in too deep when it comes to credit and those kinds of things. So.
A question is, your institution is a non-profit in the sense of...
Yes, that is true. It's not for non-profit. It's owned by the membership, and it's run by board of directors who are volunteers.
What type of products do you offer?
Everything, savings, checking, mortgage, HELOCs, line of credits, Visas, we have a fantastic Visa product. I was actually very impressed coming from a larger credit union and finding the rate to be as low as 5 point something on a Visa card. So, so it just depends. Car loans, RVs, I mean, basically, you name it, we got it.
Second, trustee, seconds on houses.
Absolutely.
Yeah.
Move
on to Dave.
Yeah. Why don't you do that?
Good morning, my name is Dave Stormont. I'm a licensed reverse mortgage rep. I have an MLS license. The reverse mortgage is basically a mortgage and nothing more than that. It's an agreement between a borrower and a lender to borrow money and repay it at some point in the future. The thing about the reverse mortgage is that for a lot of reasons it's got a horrible reputation, and that's what I'm going to talk about today, as to why it has this horrible reputation. Because having done, 500 or 600 of these things, my clients are extremely happy with what is going on. And Doug asked me a great question, and that sort of speaks to what the problem with the loan is. And that the worst scenario in a reverse mortgage is that you do it and you spend all your money, and because reverse mortgage is negatively amortized, that means the balance goes up because you're not making a monthly payment. The balance is going up. You consume all your money and you consume all your equity and you have nothing left. And that having been in the business for 13 years, when I started out, I did not understand that as being the worst case scenario. And I don't really think that's why it has a negative connotation. There's another reason, but that's the worst case scenario. That's a great question. And how you mitigate against that is first understanding that that's the worst case scenario. And when you do the loan, you make sure that you make the money you get your client last as long as they do. And there are ways to do that with the reverse mortgage. And so my goal is, when I go into a client, is to make sure that whatever revenue stream is set up, if there is one, that's going to last. And there is an option in it. It's called a lifetime payment. It's like an annuity, and it will kick off money even if you live to 150 years old. So, but there are different ways of setting this up. The other thing I'm going to talk about, and the other reason I think it has such a bad reputation is it's just a mortgage. Okay, there's nothing special about it. You maintain the property. You are the owner. You're obligated under the loaner to pay the taxes, pay the homeowners insurance, keep the place up, occupy it 183 days a year. Nobody's watching. But, when you read in the newspaper that Granny just got evicted because of a reverse mortgage, forget about the fact that she didn't pay her taxes, didn't pay her homeowner's insurance, isn't maintaining the place, is violating all the terms of the agreement. There's no way to put a good spin on that. There's just no way. Granny's on the street. And it doesn't happen very often. I think a lot of people don't realize that this is a tiny, tiny little market. In the last, since 1990, about 750 to 800,000 reverse mortgages have been done nationally. And that's against, the regular mortgage industry, which is millions and millions and millions of properties. And how many people have been foreclosed on there? But the regular mortgage is a bad reputation. Okay. So it's the audience who's getting it, and what happens is that they're at the end of their life, and the worst thing that can happen is to lose their home. And there's just no way to make that good. So I personally think that's why. And of course, when the newspapers get a hold of this, they blow it up. There was an article 4 or 5 years ago talked about reverse mortgages, and everything in the article was true. But it went back to reverse mortgages that existed back in the 60s, that don't exist anymore, and everything it said was true. But in the last sentence it says, oh, by the way, these don't exist anymore. And the damage is done. Okay, Jim, I'm sorry.
No, one quick question. But most of the clients you deal with are in some type of financial difficulty to begin with, aren't they?
I would say that's a true statement. Most people come to me because they have a mortgage that they have borrowed, and they can no longer afford to make the monthly payments. That's one of the main scenarios that I see.
Do you end up liquidating some of these people?
Do I?
I mean, does the lender?
I mean, foreclosure is an option underneath there.
If they outlive their reverse mortgage.
You can't outlive the reverse mortgage. As long as you occupy the home, abide by the terms, you can remain in the property, even if the balance of the loan exceeds the value of the house.
They can't throw you out.
They can't throw you out. The loan is called, the term is called non-recourse. That means you can't owe more than the future sale value of the home. The reason that exists is because you pay in insurance to the government. They call it government-backed, that's BS. It's borrower-backed, okay? The government is just managing the money. And what happens in that situation where the home is less valued than the balance, the insurance pays it off, the lender's whole, and the heirs never get anything.
Wow.
I have a question.
But if home values are increasing,
Then they have
it's
equity.
very difficult to have happen, isn't it?
We just witnessed in the last 5 years decreases in value. I have clients I know for a fact that were underwater, on some of their loans.
Are they now with the increase in values?
Not many, probably. Not many, but they're very close to even, yeah.
You said that the minimum was they need to stay at the property 183 days? Is that a minimum?
That's 6 months plus 1 day.
Okay, and the rest of the time, can they have a renter there, a short-term renter?
If you're occupying the property, you can have a renter. But you don't ever want to not occupy the property and have a renter because that gets really nasty.
Yeah, I understand, okay.
Yes, sir.
So can there be any safeguards built into the fact that, most of these people are really old, so how are they going to, remember to pay their taxes and all this kind of stuff? So can there be any safeguards built into the mortgage to take care of that? One.
You can set up an account. Go ahead.
And the second question is, can there be a life insurance component into this whole thing? So that
You could do a life insurance component, my good friend Jake.
If you're eligible.
If you're eligible.
That's a good
But the problem
segue.
is, they stop at 84, right?
They do,
Or
but
their
even,
80s, so-
you could be in your 60s and not be eligible. Even 50s not be eligible. So eligibility.
Yeah.
So I mean, that is a strategy I have seen people do. I don't know if I've ever had anybody actually do it.
But if you're required to live in it, but what happens if you have to go into a home?
Yeah, that's it.
Yeah, and that's again, everything is very, very clearly laid out in the terms of the agreement, so there's nothing unclear about it. And what it says in the actual deed of trust is that if you have to go to a facility for 12 months, all right, the loan becomes technically due and payable, all right? At that point, you get a very nasty letter from the lender saying the loan is due and payable, but you have 6 months after that to sell the property or have the heirs refinance it. And if you're trying to sell it and you can't, you can get additional extensions. So you've got a little bit of time. But the reality is that you don't want to mess around. If you're an heir in this situation, you want to get that property sold because the interest is adding on to the balance.
So what is the maximum assets that one can have going into a reverse mortgage?
On the FHA, well, the first thing is that all reverse mortgages are age-driven, and so that the older you are, the more money you're eligible for. So if you're 62, you might be eligible for $300,000. If you're 90, you might be eligible for $400,000. On the FHA, the maximum amount of equity that you can dedicate to it is $625,000. There are also jumbos, and the jumbos can go up to $6 million in equity. That would get you about $2.5 million. Jake.
Segue to Dick.
Yeah.
Moving on.
He was hoping I was going to keep talking.
So we do, I work with State Farm and have an office in San Mateo. It's been there 60 years. I'm the 4th agent. Everybody retired.
You don't look that old.
Yeah, age well.
He did say 60 years, didn't he?
Yeah, he did.
Yeah, it's one of the oldest offices, if not the oldest, that's continually going. What we do, State Farm, within State Farm, there's 3 classifications. There's an insurance component, there is the banking component, but it's done online, and then there's certification for financial planning. So we can do all 3 of them. We're certified for all 3, but we don't compete with credit unions or traditional banks. We're online. So that's not your traditional State Farm, but that's where it is right now. Financial planning, that's where I came from, Franklin Templeton. I was a wholesaler there, and I transitioned to State Farm 10 years ago. So what I primarily do right now, it depends. I mean, if an attorney comes in play and they bring their client and they want to do an insurance plan through their estate planning needs, we'll look at the property coverage, liability coverage, and income and/or asset protection by means of disability, life, and/or long-term care insurance. So our panelist is basically growing assets, preserving assets, and I'm in the component of protecting it for the unforeseen events that can happen. But we do a lot of a la carte too. There's a client that comes in strictly for auto or strictly for home, but we do always make a recommendation and we just leave it from there. That way we note that we made a recommendation. The key 3 things to any insurance is protect your property. Protect your property. But the large valuation on down. So that means your home and go down whatever else you own underneath. And control the coverage by deductible. And the deductible should be what you can afford. If you can't afford a $5,000 deductible, don't have it. If you can't afford a $10,000 deductible, don't have it. So your deductible should be what you can afford. The second component, which underlaps quite a bit actually, we do notice a lot of people, property rich, property values, they don't have appropriate liability. Whether it's also pet liability. You have a dog, put the pet liability in there too, because you're liable for that pet. Liability should be composed of primarily an umbrella policy. And list all your exposures, whether you have rentals, whatever it is, you list them all in there. And lastly, component, and this is primarily, all of them are based on eligibility, but lastly is disability, if you're working and or self-employed, or if you're working and you need to supplement disability. We normally work with the employer plan and supplement with something additional they might need, because once you leave an employer, your benefits are gone. So a lot of people are in job transition, they're flipping jobs all the time. And life and long-term care, it's something to consider. Even though State Farm used to do long-term care, we don't right now. But I can still recommend it and I'm certified for it. That's about it. It's, just one thing about growing and protecting is a key component for the unknown. And you always protect yourself for the worst case scenario. Everything else are bells and whistles you can add to a plan, but you always look large case loss scenario, narrow it down.
Okay, question. Most of the time now, even when you go into a hospital or doctor, they ask you stupid questions like, do you own guns? Is that an issue now? I know dogs are, okay? If you have a dog fighting and this type of thing, but is there an insurance thing now? They're asking questions, do you own guns?
We have a gun endorsement automatically on the home policy, but we don't ask you if you own it or not.
Okay.
And we don't record that.
But I mean, in a home policy, is that an issue?
No, underwriting, we don't ask you that.
Okay.
Some do. We do ask pet, and some will exclude breed.
Right, I understand that. Right.
And so there's a chain of things, but pets definitely we ask. There's a chain of questions there. But no firearm, no.
Okay, not firearm.
Richard? Richard, that's good.
Whatever happened to the adage, neither a lender or a borrower will be, and you shall be happy?
That's the old days.
Yeah.
The old days, yeah.
I had a question.
Yeah. Ed, you have a
Oh,
question?
yeah. What, Jake, what do you, to the average homeowner, say in San Mateo County, what do you think about earthquake insurance?
I get that question all the time. So earthquake insurance, we service it through the California Earthquake Authority. And so that means the rates is determined by them. We service it, and they had to create that authority 35, 40 years ago because carriers before it was included and they were going to leave California. They wanted to exclude it. The Department of Insurance said, no, you have to include it. And they were all going to leave California. And with that, the California Earthquake Authority came about and said, okay, fine, sell it through us, service it through us, but the money will be backed by us. It is our natural, obviously disaster. We're in an earthquake zone. And premiums they now have it down to a science. Before we used to use manuals, even 10 years ago, we used to open the books to see where you would be, but now we don't do that. It's basically online based, and we just enter your zip code and the features of the home. It'll come with the premium. They've gotten much better. Now single-story homes are rated significantly cheaper than what they used to be, even 10 years ago. So the rates have adjusted downwards, but anything one and above, above one, even... One is...
Story.
Yeah, stories. So now they do rate much higher depending on stories.
Let me just say a little bit about...
It is expensive, by the way.
Go ahead, Laura, you go with your question. Go ahead.
Your fire pump.
It's not a question, it's an addition. Think about this, if you don't have earthquake insurance and something does happen, do you have the money to rebuild? If not, then it might be cheaper to go with the earthquake insurance and just adjust your deductible to what you can afford in terms of, in case of emergency.
And to add, we do normally recommend, if they get earthquake, we do cover the deductible, can they afford a deductible, and we might also recommend a HELOC through some carrier they might, or lender they might be with, and just to open the HELOC but not use it technically. Some people open it and they start using it, so kind of an emergency plan. So I think you want to get approved on the HELOC portion in advance, because sometimes we do. We'll approve you, you'll have your check, and if there is an earthquake or a loss, that check is good, you can write on it. So we're not going to freeze your bank or your HELOC on it.
Skip has a question.
What is HELOC?
Oh, home equity, I'm sorry, go
Home
ahead.
equity line of credit.
Oh, okay.
Okay, Jerry has a question.
Jake, there's something I've always wondered.
Technical.
If you suffer earthquake damage in your home, you don't have quake insurance, but you have fire insurance, and something burns, then you'd be covered by fire strike because of the earthquake.
We normally don't like to answer that.
You'd be fired.
We don't like to answer
Your
that.
answer, but let me finish the question. Would you be covered for fire damage, but not for earthquake?
That's funny.
We really don't like to answer that.
It's case by case, huh?
Because generally,
Thank you.
yeah, so we don't like to answer that because there's components where it's going to be earthquake damage and fire damage, and we notice that a lot of stuff that does occur sometimes in a catastrophic loss. Some of these things are, I'm not going to say arson related, but you'll be surprised. They don't like us to answer that. If you have both policies, we technically open both of them up. So if you have the earthquake, it's not that we tell you, no, you can't submit an earthquake damage to your homeowner's policy. We'll open it up. You're just going to get declined. If they only see it's earthquake-related damage. Because sometimes a pipe breaks, so which can be an internal covered loss.
Oh, John's got a question.
Fire is a component, but...
Go, John.
Do you know what they did after Loma Prieta in 89 because the entire marina was on fire? How did they handle those policies, which might give us a clue as to that?
Some carriers their language is very specific, some are very broad. If you have earthquake authority through the California earthquake policy, you're getting coverage for it. That's just bottom line. There's no declination, decline on that. You're going to get it. If you don't have it, majority are going to decline, but some are you know, pipe bursting inside, water damage. They'll cover that component, but they're not going to cover the, you know, a lot of other things. So it really depends.
Ken, I'm going to thank you and your group, but I want to say regarding the marina, the concrete guy has a different version of what happened in there. From the structural point of view that we'll discuss another day, it was not what it appeared.
Oh, I just need 1 minute for my component, because I'm not recommending commercial real estate to anyone. So I work two areas, which is the entire spectrum. The user side, if you want to start a business now, you are going to pay rent through the sky, and the failure rate for new businesses in this county is going to go back, I'm predicting, to what it was in the 07 collapse, 08 collapse, to 02, or could be in a bubble. And if you're paying $5 a foot, for example, in downtown Burlingame, San Mateo, anywhere for a new retail business, you are going to get seriously hurt, and that could maybe take your life savings. So I'm not recommending at this point in time that you pay these really high rents. The other half of my business is the investment side, and the investment side is not returning in this Bay Area or in most of Northern California, not returning good returns that you make any money on. So how would you like to buy a property where you only make 3% and you take a lot of risk of vacancy? So you buy a property on 3%, you can't finance it because the lenders really won't give you money because it doesn't show the loan to ratio and everything like that. There's a lot of reasons they won't, financial reasons. So you have to have all cash. Then you're competing against the Far East buyers primarily, and they might slip off. So things change. So things could be different in a year or 18 months more likely, or 2 years. But right now, it's very tough. So I can take you to Elko, Nevada, or to Carson City. No, not Carson City. No. We got to go really remote. Cheyenne, Wyoming is in a deep depression. You can make 9%, but the tenant, if you're lucky to get a Walgreens, they're going to be there. However, you never know what's going to happen after they leave, and you're in a dust bowl. So, in other words, go with these guys. Don't go with me.